Oil hit $91 while gold sinks. Your war hedge is failing fast. Monday, July 20th, 2026. Like and subscribe for daily market updates. Today's agenda, the market snapshot. Oil at $91. Why Bitcoin holds $64,000. Why gold sinks. Tech stocks sell off. Fed watch and next week. Up next, oil at $91. Let's look at the numbers right now because they tell a strange story. The S&P 500 is down 1% to 7,458, dragging the Nasdaq lower by 0.14% to 25,520. Bitcoin sits near $64,270, but slipped 0.6% today. Ethereum barely moved at all, holding steady around 1,868 despite broader weakness in tech stocks. Solana is the odd one out right now. It actually gained 0.5% to sit at 76.38. That's unusual when everyone else is selling off. Gold is stuck near $4,027, up just 0.2%, while oil sits lower than its recent peak despite the war widening. The dollar index holds flat at 100.75, and 10-year yields are down 0.6 to 4.54%. Here's what this means for you. Stocks fall because Netflix missed expectations and chip stocks sold off hard. But gold dropping, while oil rises, is rare. Usually, when war widens like it did over the weekend with Iran attacking sites in Kuwait, investors rush into a safe place to store wealth. Instead, they are buying crude oil directly. I think this disconnect will snap soon, because inflation fears priced by yields punish gold more than panic does right now. But what about Bitcoin holding firm while oil burns hotter? Crude surged 4% today to hit $91. That is its highest level since mid-June, and it happened, even though oil demand might be falling according to some analysts reading the data. Why did this happen? Because Iran claimed fresh tanker attacks in the Strait of Hormuz and struck sites in Kuwait over the weekend. The war premium just moved into crude directly. When futures reopen tonight or tomorrow morning, traders are pricing a scenario where supply gets choked off physically rather than through economic slowdowns. Think about your airline stocks or retail margins overnight. If oil stays above $90 for long enough, gasoline prices jump in China and the US follows suit. That shakes consumer spending power immediately. This matters because Wall Street analysts everywhere around us all day long are ignoring this specific global political trigger while focusing on earnings reports from Netflix and Coca-Cola. They think a rate change is the only story that matters right now. I'd watch if crude gaps sharply higher when futures reopen tonight if Iran clears to sell and dollars fails, which would shake everything overnight. That brings us to why gold sinks. Bitcoin barely reacted, while oil surged past $91 per barrel. The leading cryptocurrency held near $64,000, remaining positive for the week, despite today's 0.6% decline. Typically, global chaos involving Iran attacking tankers in the Strait of Hormuz should push crypto toward a safe haven status or align with risk-averse flows. However, Bitcoin currently tracks Federal Reserve policy more closely than geopolitical conflict. Traders prioritize rate cut probabilities and inflation data over political headlines because unpredictable price swings occur rapidly without warning from Wall Street analysts. If support at $64,000 breaks for Bitcoin or resistance near $2,000 falls for Ether, we could see significant moves in the opposite direction within hours rather than days due to increasing volatility. Ethereum is leading even during this sell-off. It remains positive relative to Bitcoin, sometimes when technology stocks dump hard. The market and Fed appear to be telling different stories regarding an imminent rate change or its absence entirely. This divergence keeps crypto detached from pure war news, as investors focus on macroeconomic indicators like interest rates instead of regional conflicts. Analysts watch inflation reports closely because they determine the trajectory for asset prices more effectively than distant geopolitical events do right now, which leads to tech stocks sell off. A war widens and global political tensions escalate across multiple fronts, yet gold remains trapped near $4,000 per ounce after its worst week in 6 months. This behavior defies historical norms. Typically, when oil spikes and uncertainty mounts, investors flock to safe havens like gold for protection against currency debasement. Instead, traders are pricing out inflation rather than panicking about it. When Treasury yields stay elevated at 4.54%, they lift real interest rates, which punish gold directly by making non-yielding assets less attractive. Gold simply cannot compete with bonds offering better returns without risk if the dollar index stays strong near 100.75. I bet we will see a repricing of expectations on gold by Friday if real yields stay this high, unless something shocks the bond market first to reverse the trend. The rally ends in minutes if Warsh doubles down on his message in favor of higher rates today, which seems likely given Fed rate hike voices swell before the July decision. This dynamic mirrors 1980, when Paul Volcker's aggressive raising interest rates crushed gold prices below $800 after decades of highs. High real yields acted as a ceiling until inflation expectations finally broke through. Now, mortgage rates stall for 2 months, and home buyers aren't moving fast enough to boost the economy without recession. That represents a gradual economic slowdown rather than an immediate crash yet, but it creates second-order effects where available cash in the market tightens further. Investors must recognize that holding gold requires either falling yields or rising chaos. Neither is guaranteed soon. The concrete implication for portfolios today is shifting capital from precious metals back into short-duration bonds until the Fed pauses its in favor of higher rates stance or global political events force a sudden flight to safety regardless of yield curves. Finally, let's wrap up with what the Federal Reserve is watching and where we go next week. The Nasdaq led declines, dropping 1.4% to close at 25,520 today. Chip stocks briefly rebounded from lows but sold off hard again after Netflix missed earnings expectations. This dynamic is notable because chip stocks typically drive technology higher when interest rates stabilize, yet they are falling even as yields tick down slightly from recent peaks. That behavior suggests investors fear a broader recession rather than merely an inflation spike right now. China raised retail gasoline and diesel prices as oil jumped 12% in a week, adding pressure to the market. Global growth slows when fuel becomes expensive for factories everywhere. If China's economy cools further, demand for semiconductors will drop since they manufacture electronics there. Stocks fell after Netflix missed targets, while the chip stock sell-off hammered the Nasdaq today specifically because earnings season is kicking in hard and company outlooks look weak across the board. Sometimes a reported positive outlook contradicts reality, but investors are paying attention to underlying health rather than blindly following price movements up or down. The market reaction reflects growing caution as fundamental data reveals fragility beneath recent rallies. With inflation concerns lingering alongside recession fears, capital flows remain sensitive to any sign of economic deterioration globally. Finally, let's turn to Federal Reserve Watch and next week. The Federal Reserve's current narrative centers on a pause in rate hikes, yet the fixed income outlook remains tense as voices calling for further raising interest rates grow louder ahead of the July decision. However, market consensus still prices rates holding steady for now. Mortgage rates have stalled again after 2 months without relief, directly suppressing housing sales and extending the downturn in that sector. Investors are left waiting on a central bank policy shift to drive mortgage yields down, but until then, affordability remains stuck at historic lows. We must also monitor crude oil futures tonight. If Iran's attempt to clear transactions fails or escalates, prices could gap sharply higher upon reopening. Such an event would instantly shake airline stocks and squeeze retail margins overnight due to soaring logistics costs. If oil sustains a level above $91 for too long, consumer spending power erodes further, allowing inflation to stick around longer than policymakers desire, potentially forcing the Fed's hand sooner rather than later. Bitcoin holds $64,000 as critical support, while Ether pushes toward $2,000 resistance today. A break in either direction could trigger a larger move opposite within hours instead of days, given how fast unpredictable price swings occur these markets nowadays, without warning signals from Wall Street analysts everywhere around us all day long. This unpredictable price swings mirrors the 2018 trade war sell-offs, where minor global political sparks caused disproportionate drops before underlying health caught up. For investors, this means hedging strategies are essential. Holding cash becomes a defensive play if inflation resurfaces, while aggressive equity rotation into non-cyclical sectors may offer protection against both oil shocks and potential rate surprises next week. Today's market split between oil and gold is the real story, not just earnings misses or Fed talk. Oil hit $91 as war widened with Iran attacking tankers in the Strait of Hormuz, yet gold sinks near 4,000 because yields stay high at 4.54%. Stocks fall on Netflix whiff, while chip stocks sell off hard despite a slight yield dip. Thanks for watching Market Pulse Daily.